LP stands for limited partner. Institutional limited partners consist mostly of endowments and foundations, as well as vehicles called fund of funds, which is what Cendana, my company, is. A fund of funds takes capital from other allocators and invests it into venture capital or private equity partnerships.
Welcome, everybody. I'm Mark Peter Davis, Managing Partner of Interplay Ventures. On this podcast, I interview innovators about their strategies, industries, and decisions. Today we have Graham Pingree of Cendana Capital. Cendana is one of the preeminent limited partners in the tech community. Now, limited partners play a critical role in venture. They provide capital to the VCs, which the VCs in turn invest in companies. Graham has an incredible background, having worked at some of the top firms in the industry. He's obviously now a partner at Cendana Capital, a leading LP which focuses on seed funds both in the US and globally. He lends his wisdom into how to think about investing as a limited partner. And it's an incredibly important conversation for entrepreneurs to listen to so they can better understand how their VCs operate. I hope you enjoy. This episode is brought to you by Chelsea Capital. Chelsea Capital provides high-quality, low-cost accounting, tax, CFO, and alternative finance solutions. For those who don't know, alternative finance solutions include venture debt and other forms of non-dilutive capital. They help companies scale their operations while keeping costs low. If you're interested in learning more, visit chelsea.capital. Graham, thanks for joining us today.
Pleasure to be here. Thanks so much for having me.
I'm uniquely excited to have you on the podcast. We've spoken to founders, VCs. Having the LP perspective is a critical part of the equation. It's an important part of the innovation ecosystem that I think, frankly, most founders don't think about, but obviously VCs do every day. So before we get into your background, I was wondering if you could explain to everyone what an LP is in probably the most simple versions of that,
Sure.
to make sure that just people who aren't familiar with the term at all have context.
Sure. Yeah, absolutely. So LP stands for limited partner. Institutional limited partners consist mostly of endowments and foundations, as well as vehicles called fund of funds, which is what Cendana, my company, is. A fund of funds takes capital from other allocators and invests it into venture capital or private equity partnerships. Hence the limited partner as part of a general partnership that we invest in.
When you say other allocators, I know what you mean, but do you mind explaining that for folks?
Sure, yeah. So many of our LPs as a fund of fund are these college endowments or nonprofit foundations, sometimes family offices or corporations. They make up the bulk of the institutional limited partner base for venture capital and leveraged buyout funds.
And you guys are a fund of funds, which is another layer for the folks listening between universities and insurance companies who are providing the initial capital, and then the VCs, which eventually provide it to the entrepreneurs. Why do fund of funds exist?
Yeah, it's a good question, and I think you can make an argument that there are many fund of funds out there that maybe shouldn't exist. We believe that our strategy is very niche-y, and it serves a part of the market that it's a real challenge for other allocators to access. So at Cendana, we exclusively focus on sub-$100 million seed and pre-seed venture funds. That's a market today with hundreds, if not thousands, of funds. And for many of the larger allocators, it just doesn't make sense for them to spend the time to understand who the most compelling candidates are in a way when they're only going to be able to allocate a very small percentage of their total portfolio to that part of the market. So that's kind of our value proposition and the reason that we believe we exist. We think that specialization on this part of the market serves us well and allows us to build a really interesting portfolio of some of the top seed fund managers.
Right. So there's someone sitting at, Columbia's endowment, university endowment. They've got billions and billions of dollars to manage. A small part of it's going to VC, and there's no way they have the time to go meet all the small VC fund managers. And so you guys provide that.
Right. I think that, many of the endowments that do have venture capital allocations focus their efforts on accessing the bigger life cycle funds where they can write really meaningful capital allocations. For the funds that we cover from, $10 to $100 million, a big endowment obviously can't write a $25 million check to them. So occasionally we have a lot of endowments in our LP base that they'll write us a check, and we provide that exposure to multiple of these seed funds.
That's awesome. Thank you for that. You want to fill in a little bit more on Cendana's Focus? I know you guys have recently closed another fund. You guys manage a good bit of capital. Just for the folks listening to get a little bit of an overview on the firm.
Sure. Yeah, absolutely. Cendana's strategy focuses exclusively on sub $100 million seed and pre-seed funds. As part of our fourth fund of fund, which we closed in June of this year, we were fortunate to be oversubscribed and hit our hard cap in a couple of the series of the fund. The fund is a bit of an umbrella with, we have a seed portfolio, a pre-seed portfolio, and an international portfolio underneath it that we allow LPs to kind of allocate amongst those three series at their discretion.
So they can weight 50% to one, 25, they can pick that?
They can, and in fact, we have some LPs that only came into one of the series and not the others. So we've historically really tried to optimize for LP flexibility. I think because we're LPs ourselves,
right?
We don't like when managers make our allocation decisions for us. So we structured this as a way to try and preserve as much LP flexibility as we could.
Historically, has one of those buckets performed better? Is there any pattern?
So international is too soon to tell, although the early results look really compelling. So we're very excited about the early traction across that portfolio. Pre-seed and seed, I don't think we have a huge distinction yet. I would say if I'm thinking of our best 4 or 5 funds, they're split roughly evenly over seed and pre-seed strategies. Now, we think that pre-seed is inherently a little bit more risk. We think of pre-seed as institutionalizing the friends and family round, really kind of backing pre-product ideas before anything is built. Whereas seed today, it's a little counterintuitive because you think of it as so early stage, but most companies that are raising seed capital are generating early revenue and are trying to establish product market fit, but there are actual metrics to evaluate. So we think pre-seed is likely to be a little bit riskier. Those funds tend to be smaller and potentially a little bit higher alpha as well.
Innovation's democratizing, right? 20 years ago, it was all in the Valley. Now it's all over the country and internationally. When you think about your international program, what geographies are relevant for you guys? I know historically it was probably just an Israel story, maybe a UK story. Has that changed?
It has, although we do think that there's probably only less than 10 probably ecosystems around the globe outside the US that we think warrant a dedicated seed strategy and can support a number of local seed funds. So when we think about an ecosystem, we think the key ingredients for a seed strategy are great entrepreneurs and founders, enough technical talent to scale companies locally, early stage capital, and then local downstream capital. Mm-hmm. So even here in the US, that's been the big gating factor for us. We've tended to focus on geographies where the downstream capital is based. So principally Bay Area in New York, and to a lesser extent Boston and LA. Outside the US, the only other kind of criteria that we want to see is a deep enough liquidity market. And the way that we've kind of mitigated some of the risk around liquidity is we've optimized for slightly more mature track records outside the US. So we want to see actual DPI, which practically speaking means we're backing more funds 3 and 4 out of our non-US portfolio than funds 1 and 2, which we do a lot of here.
Do you mind defining DPI for the folks listening?
Excuse me. Yeah, absolutely. So distributions over paid in capital. So actual liquidity generated by selling companies or taking them public and then returning that to limited partners.
People got their money back.
Indeed. Yeah. And hopefully much more than just their money back.
A lot more. Right. It's a multiple on that. On how much they've invested.
Yeah. I mean, we think there is a key distinction between showing markups on paper and actually realizing those gains and getting it back to LPs. So we've really been keyed in on a DPI for our international program.
So you mentioned there's 10 geographies outside the US that you think are robust enough to support real institutional seed programs. Off the top of your head, how many can you name? I think we'd love to hear them.
Sure. Well, I can tell you where we have some fun relationships. Obviously, sure. That's a pretty good indicator that we have belief in that ecosystem. We have a fund headquartered in Toronto. Okay. So we think that Canada and Toronto in particular is a really interesting technology ecosystem. You mentioned Israel. We have a fund in Tel Aviv. We think Israel is probably the most mature non-US venture ecosystem out there, but it's we think a great region of technologists and good company builders. We have a fund headquartered in London that is a kind of a pan-European approach. We think that the European venture ecosystem is a lot more compelling today than it was a decade ago. And it actually has a lot to do with the maturation of the downstream capital markets. There are many more players today with a lot more capital that can lead Series A, B, and C rounds in Europe. So we think it's more interesting. And then we have fund managers in China and in India. Right. And I think the other markets that we continue to watch and think are kind of becoming more attractive by the day, I'd say Southeast Asia is probably at the top of the list. We know many of the fund managers in LATAM and Africa and Central and Eastern Europe. I think we probably feel like the downstream capital in those regions needs another fund cycle to continue to develop before we'd actively start deploying there.
We hear a lot about Berlin and Paris. Frankly, we see entrepreneurs applying from those geographies all the time. On the VC side, as you know, entrepreneurs in those geographies will very often move management teams to the US to tap into the US market, leaving software development or other kind of back office functions in their local geography. And very often they like New York because the time zone's a little better for bridging between Europe and the US. Are you seeing a lot coming out of Berlin or Paris?
We are, yeah. So the London-based manager that I mentioned, I'd say France is one of the kind of 3 ecosystems that he's principally focused on, and one that we think is a lot more interesting today. I think part of the big change there has been cultural. So when I lived in London in 2005, 2006, the idea of us when I was at Horsley backing a French venture capital fund, it probably wasn't going to happen. I think there was still a lot of stigma around failure, and entrepreneurship just wasn't quite as celebrated. There were still some structural impediments to running a startup in terms of the ability to hire and fire quickly.
Right.
I think all of that has changed pretty dramatically. And there have also been some really big European success stories that this generation of entrepreneurs can now look to and say, we can build really big, successful companies here in Europe. So again, we think Europe's a much more interesting place today. With regard to Berlin, I should have mentioned, I was talking about kind of our core relationships. Our portfolio strategy, 90% of our capital goes to what we call core commitments, where we are often the largest limited partner. We're always one of the 3 largest. But but we also carve out 10% of our funds to do what we call pilots. And those are smaller checks, typically $1 million to $2 million, where we really like a fund manager, but there's some aspect of the strategy that we want to spend a little bit more time kind of understanding and getting comfortable with. We did a pilot to a Berlin-based pre-seed fund.
Very cool.
Partly because it was a little bit complementary to our core position with the London-based fund I mentioned. The Berlin managers focus more on the DAC region, and we do think that Germany and Berlin in particular is a really compelling hub for entrepreneurship today.
So in my experience, and you know this better than I do, there's a lot of volatility in returns by fund for a given manager. So manager A might kill it in fund 1, fund 2 is terrible, fund 3 is awesome. Just because when you have a lot of variance in the outcomes of the underlying portfolio, it can really swing things in terms of the overall fund return. Given that, I don't know if you agree with that, but if you do agree there's a lot of volatility within a given fund's or manager's cycle, what's the right number of funds for you to have as an LP in a portfolio to manage that, to mute that out through scale?
Yeah, I think I generally agree with there is a fair amount of variability in venture performance by fund cycle, even within one particular manager. Our fundamental thesis at Cendana is that small funds outperform over the long term, and I think part of the reason you see a lot of that variation in performance is because funds outgrow their strategy and then underperform in the future. So we hope that by being focused exclusively on small funds investing at the earliest stage, that we insulate ourselves from some of that variability in future fund performance. The hope is that by staying disciplined on this part of the market, that we'll be able to consistently outperform and find managers that can do that. That said, we recognize that it is venture capital. It is a power law game, and we want to build a thoughtful portfolio ourselves. To put specific numbers on it, the most concentrated core portfolio that we run is probably 5 or 6 fund commitments, and the most diverse is probably a dozen. So 6 to 12 core positions where 90% of the capital is being deployed. That feels like the right range for us. Yeah, and
right.
That results in a portfolio of a couple hundred companies in a fund of fund. And I should have mentioned before, we're very focused on fund managers that are leading their rounds and being really thoughtful on portfolio construction. So they're targeting meaningful ownership positions and are adequately reserved to protect that ownership through liquidity. So long story short is, we build a concentrated portfolio of GPs who are building a concentrated portfolio so that any one company can still have a real impact on our fund of fund.
Got it. Okay, so if you're an individual LP out there, not institutional, and you're thinking about getting in this game, handful of venture funds, probably the right strategy?
Yeah, look, I think there's some parallels to angel investing, right? You probably don't want to just try your hand at 2 angel deals. You're going to want to build a portfolio. I think a fund portfolio can be, more concentrated than a direct portfolio because funds are less risky. There's lower likelihood of any fund that contains a portfolio of companies going to zero than obviously any single private investment. So yeah, I think I would say a handful of fund commitments for an individual is something that could make sense.
Could you elaborate? You had mentioned before a moment ago about funds outgrowing their strategy. Can you explain what that means to folks and maybe what some signs are that you're looking for?
Yeah, sure. So the incentive structure in the venture industry, most of the compensation is based on the 2 and 20 model, where a fund charges 2% management fee and 20% of the gains as carry. It's easy to see how, once a manager has some modicum of success, that incentive structure pushes most people to try and raise more capital and replicate the same success with a larger pool of money. We don't believe that venture as an asset category scales. We think the ability to generate a 3 to 5 to 10x net fund, it's just mathematically meaningfully harder with more capital under management. So that's kind of informed our focus on small funds investing at the very earliest stage. But the reality is, most fund managers do get bigger, and all of a sudden, instead of writing a collaborative check where they could be, a small part of a syndicated round, now that they have enough capital that they have to compete with the other investors that they previously collaborated with.
Mm-hmm.
And being able to do that successfully, it's a different game, and in some ways can be much harder.
And you mentioned the data doesn't support part of your overarching thesis, and maybe I'm misunderstanding this, that larger funds are generating as much yield. Is that a universal, and you look at the asset class, funds under 100 million are just putting up better numbers in general than funds that are 500 million or $1 billion?
Yeah, I mean, I don't have the comprehensive data set, but I will tell you, over the course of my career and having seen performance numbers from some great data sets like Cambridge Associates and Horsley over the last 20 years, and also what we've built so far at Cendana, I think there's a real correlation between outperformance and smaller fund size. Cambridge has done some research papers that have indicated, emerging managers, which tend to be smaller,
right,
account for a meaningful part of the top venture performance in every vintage year over the last decade.
Fascinating.
And that's a big part of what we believe.
How many funds do you guys look at each year?
No, we should do a better job of quantifying this. I'm sure it's something we could pull from our CRM.
Yeah, ballpark. We're talking hundreds, or what's the scale?
Hundreds. Yeah, certainly hundreds.
So you're seeing patterns when you look at that many opportunities. You're starting to see what rises to the top a little bit.
Yeah, I mean, we have, as mentioned, some structural things that we focus on that helps us screen out a fair amount of the noise. We're focused on funds that are leading their deals. We're focused on funds operating in geographies with enough downstream capital. So it helps us hone in on strategies that would be the right fit for the Cendana mandate. But at the end of the day, we're also looking for stuff that is unique and differentiated, and that we think will give that particular manager a long-term competitive advantage and allow them to deliver outperformance over the long term.
Yeah, that was my next question. What makes one seed fund better than another? And, I'm sure there's no simple answer to that, but what are some examples of advantages that you think are meaningful?
Yeah, I mean, this is really the kind of special sauce to what we do, right? I mean, I think the structural lenses that we use, anyone could apply those. And there is no universal answer to like what makes a seed fund great. Sometimes it's as simple as the remarkable networks of the GP or the team. They are in a position to see some of the most interesting deals and have the personal brand to win those, and entrepreneurs want to work with them. I think as the seed market has matured, We do think there is some brand differentiation. So many of the incumbents today that we've been backing since 2010 have built up strong enough brands that founders actively seek them out and want to work with them. So I do think that there is some brand equity today at seed. And then sometimes it's something about their strategy that is unique. So sometimes it's a thematic focus on a particular vertical and super deep domain expertise and a network within that particular vertical. I think that's a way that can get us excited about backing a manager, because we believe that they're going to be uniquely positioned to win, to see and win the deals in that particular vertical. Sometimes it's something structural about the fund. We back some funds with different kind of equity for services model that allows them to get incremental ownership beyond just their financial investment. And that can create some pretty attractive returns when that goes well. Sometimes it's a geographical focus, right? We have backed fund managers that we think are the dominant brand for deal flow within their particular ecosystem. Mm-hmm. And we think that can be a successful way to win as well.
Some of the firms out there, this stake, I think it's very common in private equity, try to stake the funds. The limited partners put the biggest check in, and they take not just traditional, they pay not just traditional fees, they also participate in a different degree of ownership of the fund itself. They'll get a part of the GP stake, maybe participating in their carry, maybe even some of the management fee. Is that, do you guys see a lot of that at the seed stage? Do you guys do that? It's a confusing term because people will say they seed the fund, but we're talking about seeding seed funds.
Right.
What does that look like?
Yeah, it's not something that we do at Cendana. Because we're focused on these very small funds, often nascent partnerships that are just trying to get going, their fee base tends to be very small anyway. We don't think that it's fair to take economics from a very small fund. And we also don't think it's optimal. We want to be backing the very best teams. We kind of think that the very best teams want to be independent and, own their destiny. And we think there's some adverse selection in terms of fund managers that are willing to sell a part of their future economics in order to get a fund raised.
That does make sense.
It's not a part of our strategy, and candidly, we kind of recommend fund managers try and avoid it if possible.
Okay. Now, you worked at Horsley Bridge before doing your MBA. And for those who don't know, Horsley Bridge is a pretty big name LP. Do you mind giving a little overview of the firm, just briefly? And then I'm interested to hear, why you ended up there, the whole thing.
Yeah. So I started out of undergrad at another pretty well-known institution in the investment space called Cambridge Associates. And they are an advisory firm that provides consulting services to most of the endowed nonprofit world on how to allocate their portfolios. During my time there, I worked with several large clients that had a lot of venture capital and private equity exposure. And so when I moved out to San Francisco, it made sense to look for an opportunity that was, instead of on the advisory side, actually deploying capital, writing checks into funds. And when I was at Cambridge, a lot of my mentors said, if you want to go to a fund of funds, Horsley Bridge is really the top of the heap. They have one of the most respected brands and access to some of the very best venture funds. So I was fortunate enough to land a role there as an investment associate. And it was really a foundational part of my career as an LP. And Horsley is a firm that was actually founded on the East Coast, but has been located in San Francisco for decades. I was really lucky to work there when kind of the founding partners, Phil Horsley and Gary Bridge, were still there. They were mentors of mine, as well as many of the managing directors who are still there today. They have been in LPs in most of the top brands in Silicon Valley, from the very nascent days of venture as an industry, as well as a number of growth equity and leverage buyout managers as well.
So Cambridge Associates and Horsley Bridge, those are two of the big names in that community. This is one of the reasons I was excited to have you on the show, is you're incredibly pedigreed in the LP community for venture. And for those who don't know, Cambridge Associates also essentially provides the benchmark for returns for venture firms. Every year is a new vintage. So if you're a 2015 vintage, they'll say if you've made this much money in return, you're in the top decile or quartile of all the funds. So they kind of they set the standard for how VCs evaluate their performance. It's a pretty significant role in the market.
Yeah, I mean, both experiences for me were really fantastic. I think one thing that Cambridge and Horsley share is that focus on data, and the data's both quantitative. They collect a lot of information about track records and investment performance, but also qualitative. One of my favorite things as a young person at both of those firms was being able to go back and look at meeting notes from decades before. And it was just, as someone who's kind of a student of the venture world and history, to be able to go back and read.
Was there a meeting or a person that you remember looking back on? Some iconic VC that...
Not specifically. I mean, Horsley was LPs in, Kleiner and Mayfield and Matrix from their, first or second funds. So being
Amazing.
able to go back and read those meeting notes and investment memos back before those were brand names, it was really pretty cool.
It's like it's VC history.
Indeed. Yeah.
Absolutely. Okay. Where do you see yourself in the next 10 years? You've been doing this for a while. Sounds like you found a home. What's the path forward?
Look, I think we're building some really exciting stuff at Cendana. I think we've been able to walk the line between staying disciplined and staying focused on our part of the market, while layering in some new initiatives as well. Pre-seed as a separate portfolio didn't exist in our third fund. So breaking it out as part of Fund 4 was a little bit of an evolution for us. And similarly, international is still relatively nascent for us, and we think there's a ton of opportunity to find great managers around the globe.
I think you're right.
I think there are other interesting and complementary strategies that we could pursue that would be symbiotic with our kind of core focus on small and early stage funds. And look, I think our kind of flagship product is still exciting and really compelling from a return perspective.
Very cool. Is there a product that you guys imagine adding in the near future? I mean, it sounds like you just made the big leap internationally, so maybe you've got your work cut out for you.
Yeah, I think we're focused on building the international program, and so nothing imminent, I would say. Okay. But there are always ideas that we kick around internally that could emerge. I think we're open to something growing organically, but we're excited about the kind of lines of business that we're in right now.
Okay. All right, Graham, last question. Broad one. What is the most important thing you've learned as an investor? Looking to impart a little wisdom here to the people listening. I think this whole conversation has been incredibly informative for folks in bringing them into the context of what's going on up the chain if you're an entrepreneur. But I do think a lot of people will be listening to this who write checks into funds directly. So any guidance?
Yeah, I mean, I think the single most important part of our job is evaluating people. I think it's probably, I'm sure evaluating people is paramount at all types of investment decision making. But as a limited partner, it's not like evaluating a direct investment opportunity where you have a business model to evaluate and diligence. We're investing in a blind pool of capital. Sure, there's a strategy and a focus, but at the end of the day, it really is all about the people, and that's what engages me the most, and what I find the most exciting. It's also, the most challenging part of the work. So I think my piece of advice on the limited partner side is really, at the end of the day, the people are paramount, and that's what you have to focus on.
Terrific. Thank you for making time to join us.
Pleasure is all mine. Thanks so much.
Big thanks to Graham for giving us a glimpse into the secrets of the LP world. LPs are VC's ultimate customer. Understanding them is important to understanding VCs. If you liked what you heard, please hook us up with a like or a 5-star review, and feel free to share with a friend. You can find me on Twitter @MPD. To hear more of my conversations with innovators, subscribe on YouTube, Facebook, or any major podcast platform. Just search for Innovation with Mark Peter Davis.